You are watching Trading Day on BNN Bloomberg. Thanks so much for joining me. I'm Amber Kanwar. Well, you can't get away from one of the biggest trending trades right now. The meme stock craze is back. Shares of Gamestop are soaring to their highest level since 2021, sparked by the return of online commentator who helped to drive a frenzy for the stock during the pandemic. Keith Gill, or as he's popularly known by his social media alias Roaring Kitty, made a cryptic post on his X account. He's made several since putting this initial tweet out. It's also the first time that he's tweeted in about 3 years. It sparked some sort of speculation. I can't really tell you what it is because I don't know what this means or any of his other subsequent videos. But I can tell you that the market reaction has been swift. Take a look at shares of AMC, also BlackBerry, surging, kind of anything in that meme universe. And while many investors will chalk this up to being generally a sideshow, it does come at an interesting time for the markets where we're wondering, is monetary policy restrictive enough? Certainly, inflation readings have been telling us maybe the answer is no. For nearly 4 months in a row, inflation in the U.S. has been surprising to the upside. We'll get a fresh read of that in 2 days. John Zechner is the chairman and founder of Zechner Associates. And I know, John, that you don't really play this craze, but I'm sure that you have to pay attention to it to some extent.
Oh, absolutely, Amber. Just like we did back in 2021. And actually, we were fortunate enough to have been playing BlackBerry at the time for fundamental reasons. And I remember selling the stock at like $25 or something ridiculous when all this excitement came. But it has nothing to do with fundamentals. This is pure speculation. But I think your point is well made. It's been fueled by the idea that interest rates are going down. And obviously, on lower interest rates, so you fuel more speculative activity in financial assets. And you're seeing a little bit of that. And it also shows you, the power of the internet and the distributive channels and retail in general that they have nowadays that they did not have, in prior decades, in the ability to move a stock that dramatically and obviously squeeze any short positions.
Well, I was just going to say, and maybe the perils of short selling, 24% of the shares outstanding in GameStop are short. And I know that some years ago you closed up the short book.
Yeah, when you look at it, Amber, in this environment, short selling is a tougher game at most, and you got to remember, you own a stock, your liability, your potential loss is 100%. Okay, in a short position, your potential on liability is unlimited. You could lose 1,000%, 2,000%. Your upside is limited to 100%. So there's that going for you. And we did it for other reasons. I mean, quite honestly, the cost of running the fund were going up dramatic. Prime brokerage fees. I mean, right now, if you wanted to go and short Trump media, say, could you actually find stock out there? And what would you have to pay? If you have to pay a 70 or 80% annualized rate in order to put on a short position where you can at max make 100%, I mean, that's just a silly risk reward to be playing. So it's out there, it'll happen, and people are doing it, but it's certainly not where I've got any of my focus right now.
Well, it's interesting where people are taking bets. GameStop is one of them, but we saw Shopify last week get run over. The percent of shares outstanding that are short, less than 2%. And if you were short, I mean, you did make a pretty penny on that decline. Because you're long only, did that stock become more interesting to you on the back of pressure?
It could become more interesting, Amber, and you and I have talked about Shopify a lot before. It's still a valuation challenge, and problem I've got in the short term right now is they are going to be sacrificing profitability somewhat in the short term in order to sort of establish their position longer term in growth, and that is costing you margins, that's costing you profitability, and that's probably why the stock got hit so hard as it did, 20% last week on a single day, and the expectations were very high. So I mean, that's sort of the story of the market right now, though, Amber. It's really a hit and miss. The winners on when the earnings come out are doing okay. The losers are getting absolutely demolished. And maybe that tells you a little where expectations are in general, but we're sort of more neutral on stocks in general as an overall. I don't see a big move, but I think stock picking is really becoming hugely important because you look at some of the like say the misses, the rail companies, other you mentioned Shopify, those stocks really get hit surprisingly hard.
So let's talk about which dips you are buying and which ones you aren't. With that lens that you want to stay neutral stocks, you did have an opportunity to buy some lagging tech. Meta is a great example of a stock that got run over again on spending initiatives. Nvidia did dip, but it's pretty much recovered all of those losses.
Yeah, you're right. Nvidia is still trading up to the high, and we still own it, and they're still positioned well. I mean, the earnings will be out next week, and we'll see. But obviously, listening to all the data center commentary and from the hyperscalers as well as their continuing spend, they are continuing to build out the infrastructure for the implementation of AI. And the H100 and the Blackwell, the next generation of that, still has better than a 90% market share, and that's Nvidia. So these guys will own the game for another year, 2, 3, something like that. So at 35 times, yeah, it's not cheap, but I tell you, the rest of the group is not that particularly expensive. But the next wave will be the implementation in software and applications of the use of AI, and clearly, you look at Meta that got hit pretty hard on their spend, and they will probably benefit as much as anybody. Like, the hyperscalers are well positioned; they're the ones doing the spending. But you look at it, some of the biggest benefits of AI is going to become in targeted online advertising. It's going to the productivity, the efficiency of this is going up most dramatically. Who owns that market? Two guys, Alphabet, Google, and Meta. So, that's, you get more players in there. And the other thing is the applications. As you roll out the applications of AI, the guys who have the applications, whether it's going to be Salesforce or whether it's going to be Meta or a degree Alphabet with Gemini and others, they will be the beneficiaries as well. But the first stage is building the infrastructure, and Nvidia is still leading that charge.
It's interesting as you talk about what are those other plays, Meta being one of them. I'm curious where Apple fits into all of that because, it was a laggard, but after its earnings, all these AI headlines start to get attached to Apple. Today, it's rising and outperforming the market on reports that there's a potential deal to be had with OpenAI on the devices.
Yeah, Apple. I saw that one, and sure, they're going to implement onto their basic software framework, the iOS, all of the applications going forward. And there are only 2 operating systems effectively for mobile right now. iOS, which is more than 50% of the market, and the Android, which is Google or Alphabet owns. So which is why some of these others failed, other providers earlier on, because the applications builders do not want to build for more than that. So they will continue to benefit from that. iOS will grow, and that is an asset to them. Having said that, Alphabet's big win in the stock market, it really is a lot of financial engineering when you think of it. Amber, you step back. Over the last 10 years, the net income growth, the actual net income of the company has been low single digits. The fact is they throw off tremendous free cash flow. They use that to buy back their own stock. Obviously the share count goes down, the earnings per share goes higher. This ends up, giving a higher multiple. I used to talk about this when I taught a class at York University to the business students about, how we create this vision of higher capital. And then they've also done smart financial moves beyond that, which has been, they went out and borrowed, $100 billion at 1%. The losers were, the buyers of that debt, but this is a company that already had cash on the balance sheet, and you go borrow all of that money. Smart financial move. In the end, yeah, iPhone sales are driving them, but people are migrating away from those higher end phones. You're getting more competition from cheaper Chinese models, even at the high end. So, yeah, Apple will do fine. I don't think it's a 30 multiple stock. We don't own it right now. There's other things in technology that I find can find better growth at better valuations.
Yeah,